It's fair to say that the non-standard auto insurance segment has experienced a difficult decade with an average combined ratio of 106.5 over that period. That figure improved in 2017, and positive signs of momentum were also evident in the first half of 2018, according to an AM Best report. I'm John Weber for AM Best TV. Here to discuss the report and the segment in further detail are Associate Director David Blades and Financial Analyst Bob Skrabal. And Bob, why was the past decade so difficult for non-standard auto writers?
Our report focused on personal auto companies who write a majority of non-standard business, but a lot of these same trends have been affecting the entire personal auto segment. First is rising frequency because of the economic recovery and lower gas prices. That means more people are driving. And also the non-standard auto segment is more price sensitive, so that means that these problems have been exacerbated in this segment. There's been an increase in smartphone usage and distracted driving, which is causing more accidents. And also some suspect that the legalization of marijuana is also leading to more auto accidents, and that'll become an increasing problem as more states legalize the drug. We've also seen rising severity. People are buying more expensive cars with sophisticated parts like sensors and cameras, and also because of lower gas prices, people are buying larger cars such as SUVs, and these cars do more damage than a sedan would. We've also seen rising medical severity, and also lawyers are becoming more active in claims, and they're getting involved at earlier times in the claim process, which is also driving up loss adjusting expenses. Lastly, a factor specific to the non-standard auto segment is they're facing adverse selection and increased competition from standard auto writers. These larger standard auto writers have economies of scale and lower expense ratios, and they also have developed more sophisticated underwriting and pricing tools, which is allowing them to select the best non-standard risks.
What factors were behind the somewhat positive shift in performance?
Most of that is largely due to rate increases taken by auto insurers. And although there were some early actors that did raise rates incrementally over the past several years, a lot of personal auto writers took aggressive rate action last year and into this year. Also, the frequency trends have subsided, and the severity trends have become more positive lately. Another factor that's led to the improvement is improvement in the adverse reserve development trends that we've seen. Since the economic recovery, adverse reserve development has been increasing, and that peaked in 2016, and last year that began to improve. So we saw a 2-point improvement in the combined ratio in 2017, and through third quarter this year, we're seeing a 6-point improvement, and that's largely due to the rate action that took place last year. Those premiums are starting to earn through for the insurance companies. Also, during the economic recovery, like I said, that non-standard auto policyholders are more affected by differences in the economy. They're more price sensitive. So as they are buying more policies, these non-standard auto insurers are getting more fee income, and this has become a larger part of non-standard auto insurers' revenue. And although the non-standard auto composite reported positive net income this year, which is the first time in the past 3 years, they still haven't reported positive underwriting income in the decade. So given the intense competition in the personal auto segment, it remains to be seen how long insurers can remain their current pricing discipline.
David, how does the underwriting performance of the non-standard auto writers compare with that of the private passenger market?
Okay. Well, we do talk in the report, and we do actually compare the performance of the non-standard auto segment with overall private passenger standard auto writers. And what we've seen is that over time, over long term and even over just a 5-year period, the combined ratio, a key measure of underwriting performance for insurance companies, the combined ratio for private passenger non-standard auto companies has consistently been several points higher, less favorable than that of private passenger standard auto companies. And generally what we've seen is that it's the expense ratio associated with writing non-standard auto business that's really driven that difference, for the private passenger non-standard auto companies. And when you look at kind of the uniqueness with regards to non-standard auto, basically you're talking about some shorter term policies, can be 1 month policies, 3 month policies, 6 month policies. So if the insurers have to touch these policies that many times during the year, oftentimes there are additional expenses that are associated with that. And that's one of the factors that's definitely driven the difference in the expense ratio. And like I said, that's been the key factor with regards to the higher combined ratio for non-standard auto riders. One of the things that you look at also when considering the comparison is that there are a number of major market players in the private passenger standard auto composite that have direct distribution channels, and therefore it kind of lowers the overall expense ratio for the standard auto rider. So again, that helps create that chasm between the performance of the two marketplaces. But in general, it's that underwriting performance overall that has driven also the difference in overall returns, both on a pre-tax and after-tax basis, whereas the returns for non-standard auto companies are generally inferior over time, been lower than the returns that you've seen produced by the private passenger standard auto composite. So again, there's that difference there, but it's being driven by the underwriting performance. And we also go into the report, we kind of do show for the first time when we were assessing the non-standard auto market, we talk about the overall building block approach of AM Best in terms of evaluating and rating insurance companies, and that regards looking at balance sheet strength, operating performance, business profile, and enterprise risk management. And from the overall operating performance standpoint, while the majority of non-standard auto companies are rated adequate, 32% are rated either marginal or weak, and that's a much higher percentage than you see for other market segments. So again, you see some of the difficulties manifesting there in terms of the operating performance of non-standard auto companies in comparison to standard auto and even to other market segments that we look at in our overall building block approach.
What do you think the biggest challenges will be for the non-standard riders as we move through 2019?
Well, I definitely think, you get back to fundamentals. I think, first and foremost for non-standard auto companies, they again have to embrace the uniqueness and the unique risk challenges that are presented by insurers that seek out non-standard auto coverage. And again, handling the basic blocking and tackling in terms of making the right risk selection and charging the proper prices going forward, that's always got to be job one as far as looking forward on, in terms of how to be successful in the overall marketplace. Also, I think the most technologically advanced companies, the companies that put the proper underwriting tools in the hands of their underwriters to perform the best risk selection and to make the proper pricing decisions, in addition to having the systems that allow for the most efficient processing of the business, I think that's also going to be something going forward that'll continue to be important, that non-standard auto companies will have to put those tools and employ those enhanced systems to make sure that they are not only underwriting to the best of their capabilities, but also doing so in the most efficient manner possible to deal with, like I said, the higher elevated expense ratio profile of writing non-standard auto business.
Gentlemen, thanks for taking the time to speak with us today.
Thanks.
Thank you.
You can find the report online at ambest.com. For AM Best TV, I'm John Weber.